Very nice to be here. Thank you very much for the invitation. I'm based in Warsaw, so I cover what I like to think of the EU countries that are not in the Eurozone. So I look at Poland, Hungary, Romania, Czech Republic, and Bulgaria. But today, what I would like to do is focus on the three biggest issues in the global economy that we are thinking about and focused on, and then at the end, look at how those affect Bulgaria in terms of the policy environment. For a small, open economy like Bulgaria, it's very important what's happening globally. I think it's also a very important time to be focusing on what's going on globally to make sure that policymakers are not being complacent about what needs to change. I think there is a sense that we are still on the same path that we've been on for the last 30 years, which is one in which globalization is causing ever-rising integration among economies. But there's really a feeling among those of us in the profession that we are at a pivot point where the globalization that we've come to know has either paused or started to reverse, and that the environment for convergence and growth is getting much more difficult. So what I would like to do is focus on these three themes globally and then bring back to Bulgaria, looking at inflation, wages, growth, and then the policy priorities here. So let me start with what I consider to be the biggest story over the last 12 months. And that is that inflation has fallen sharply without a major cost to growth. So let's start here. This is inflation in the world, advanced economies, and emerging markets. Now, this is measured in a month-on-month, then annualized basis, which is a little bit different than maybe the way that you see it, but that you see it normally reported. But what you see here is that inflation is basically back at the pre-pandemic levels. So after rising, depending on the country, from 9% to 13% where it peaked, again, some countries were higher, but that was on average, we're now back in the 3% to 4% range in most economies. Now, it may not feel like a big success when you go to the grocery store because the level of prices is still high. But in economics, we focus on the change in prices. You very rarely get an outright fall in prices, and usually when you do, it's a very bad sign. It means the economy is very weak. So what our goal is in bringing policies back to where the rate of change in prices is no longer increasing quite so high. And this is a big success. So the question is, the second aspect of this that is this positive surprise is what's happened on GDP growth. So GDP growth has been much better than we expected. Inflation came down largely in line with our forecasts, but we had assumed that GDP growth globally would be much, much weaker. Now, the biggest surprise has been in the United States, less so in Europe, but United States and China have been much stronger. You see, the United States has been 2% stronger than what we forecast. Now, the story in the United States is largely about there's two main aspects of why the economy was so much stronger in the United States. One is that government spending was much higher, not in a sustainable way, but the fiscal deficits increased much more than we expected, about 2% of GDP. The second is that households, and this is also related to government spending, households had accumulated a lot of savings during the pandemic, which they could run down over the last couple years. So unemployment remained low, consumption was much stronger, and then government spending was very strong. So GDP growth was much stronger than we expected. But so how did this happen? So a lot of economists, some famous economists like Larry Summers, thought there was going to need to be a sharp increase in unemployment in order to bring down inflation as much as we have seen. So how do you make sense of much stronger growth and yet still very good progress on inflation? And the answer is basically that the supply side did much better. One thing that you saw in advanced economies is much stronger immigration, so the labor force participation expanded, and when you get more labor, more people working, it's less pressure on prices than otherwise. The second is that businesses started investing much more than we had expected because they were responding to the very strong consumption, strong demand for products. The third is that the supply chain bottlenecks, the things that we saw where it was difficult to get goods from Asia to the Western economies, they alleviated. And then finally, what you see here is that energy prices just simply corrected much faster than we expected, in part because of a huge increase in supply from the United States and non-OPEC production in general. So this is all a very positive picture, that we have not had as much of a cost. Now, some of this is not sustainable. The fiscal spending in the United States is not sustainable, and we'll have to eventually moderate those deficits. But for now, this has been a victory that you haven't had to have a big increase in unemployment anywhere in order to bring inflation back down. So now let me go to the second major global issue that we are focused on, and this is particularly acute here in Central, Eastern, and Southeastern Europe, and that is what's happening on household income. So what you see here is real household income for the CESE region, Central, Eastern, Southeastern Europe, versus advanced Europe, and this is household income correcting for inflation. And what you see there on the right-hand side is that it is simply booming. And this is a very standard thing that happens in towards the latter part of an inflation shock. When inflation first happens, businesses are able to raise the prices that they charge us faster than they feel obligated to raise our wages. Prices move faster than wages. So in the beginning of a shock, your real income goes down, and it is difficult to buy things. Over time, nominal wage growth goes up, and you eventually get your purchasing power back. So what we're seeing here is the purchasing power in this region is rising very quickly. For now, we expect that this will gradually start to moderate. There's three factors that are pushing up wages in this region. One is what I just mentioned, which is people are seeking compensation for the prices that have increased already. The second is that minimum wages have been increased by the government in all of these countries quite sharply. And the third is that labor markets are quite tight, which gives workers more leverage to seek wage increases. Now, it is difficult to be very particular about what the contribution of each of those factors is, but the one factor, which is seeking higher wages as compensation for previous inflation, we expect that to be moderating going forward, because what you see here is that people expect inflation to fall. So if people expect inflation to fall, they will be asking for less compensation for inflation. So we expect wage growth to slow. Now again, this year and next year, we think wage growth will be strong enough that that is what will drive a lot of GDP growth. Some people may use their higher wages to rebuild their savings. That's something we're seeing in Poland. But in general, this year and next, we think retail sales, so the purchase of goods and services, is going to be quite strong. But let me end this part with what our concern is. The concern in this region is that wages are rising much faster than productivity. When wages rise in line with a productivity, a business does not mind paying more money because they're getting more out of the worker. But right now, wages are rising much faster than productivity, which means two things. The first is that it means that labor costs for firms are rising. And the second is it means that the competitiveness of firms is falling. These are two sides of the same coin. Now, when wages are rising faster than productivity, a business has three decisions to make. The first is that it could lower profits. And this is something we've started to see in much of Europe, which is that firms had very high profits during inflation, and they compressed those profits as one option. And for society in general, when profits are extremely high, this is the preferred response to higher labor costs. But our worry is the second and the third thing that I mentioned here. If firms are seeing a rise in their labor costs and they see that the consumer is very strong, the risk is that they will pass on the higher labor costs in the form of another bout of inflation. So that all the progress we've seen on inflation could start to reverse. And then the third point here is that alternatively, they could deal with higher labor costs by laying off workers. I think in general in Central and Eastern Europe, this feels very unlikely because unemployment rates are very low. The supply of workers is very low. Firms don't want to let workers go because it's difficult to find them again. But the second and the third are the two things that we worry about when wage growth is very high. So again, wage growth in general is a very good thing in the sense that seeing rising purchasing power for households is a good thing. But if it outpaces productivity growth, we worry that it can push inflation and unemployment. And now let me go to the third issue, which is perhaps the most important, looking further out. Our worry about medium-term global growth. This chart shows our forecasts 5 years out ever since the year 2000. So it shows the forecast from between 2000 and 2030. And what you see is that our forecasts of growth have been plummeting. And this is not just our forecast, this is also the average of private sector forecasters as well. At present, we estimate that global growth will be 1 percentage point slower than the average that we've seen in the last 20 years. It's important not to be light about this. The consequences of this for all of us are quite severe. Lower living standards, lower reduction in poverty, more social tension, and it makes it harder to do the green transition. So this is really an urgent issue that growth is slowing in this way. Now you could say that during the pandemic, it's not that surprising that growth fell. But again, this is much broader than just one particular crisis. This is something that we've now seen baked in. And the worry, of course, is that as you see lower growth, you get more pessimistic about growth and then you invest less, which then lowers growth further. So there's a self-reinforcing aspect to lower growth. So why is this happening? This is global growth split into the three factors that explain GDP growth, if you remember from your economics classes. One is the change in capital, the second is change in the labor force, and the third is TFP, which is total factor productivity or productivity. And what you see, the biggest driver is that TFP, productivity, is slowing. So part of the reason that we are forecasting lower growth is that the underlying components of growth are growing more slowly. Productivity is growing more slowly in part because there's a sense that all of the low-hanging fruit have been picked and that additional gains in technology are harder to find. Then second of all, businesses have been investing less, again, for the factor that I was talking about pessimism reinforcing. And the third, something that's known well here, is the issue that the workforce is growing more slowly. In some countries, like in Bulgaria, the workforce is actually shrinking, but demographics are affecting everywhere other than, fertility rates are below replacement everywhere but Africa and a few countries in Asia. So the fact that the workforce is growing more slowly. So part of our concern about medium-term growth is just the underlying structural trends that we see in the data already. But a second part of our concern is the new risks are coming, and this is perhaps our biggest concern. This just is a chart of global trade. And what you see here is the rise from the 80s until the global financial crisis. This was the magic period of globalization. It's not that everyone was a winner in this period, but particularly for I mean, within the United States, there's what's known as the China shock, which is that US growth in general did very well, but communities that were particularly affected to offshoring to China were affected quite negatively. So there were winners and losers, but on the whole, this was a period of rising global income and falling poverty. And since the global financial crisis, that growth in globalization has stopped. And now, our current forecast for trade is that it will edge down, but there are downside risks to this. We did an analysis of how trade has evolved since the rise in geopolitical tensions. And what you see is that countries that have different geopolitical values are now trading with each other less. So there is much more within bloc trading rather than between blocs. Now, there's several countries in this region that see this as an opportunity. There is a sense that there was the idea of friendshoring that many of you may have heard of, which is the idea that foreign direct investment will now locate more in Central and Eastern Europe rather than in Asia, because there's a desire to be trading more between countries of similar values. At the same time, there's what was referenced previously, which is the idea that China could be investing more in this region than it was before, because it is much less politically sensitive for a Chinese firm to be located in Hungary or in Poland or in Bulgaria and then exporting to the EU rather than exporting directly from China. This is the model that was followed by the Japanese in the 1980s. In the 1980s in the United States, there was a big resistance to Japanese cars showing up in the United States. And in the end, there was a series of protectionist measures, and the solution that was found is that Japanese firms started to do FDI into the United States. And so nowadays, cars like Honda and Toyota are seen as less foreign because they are made in the United States. And so it's possible that that's a model that will be found. But in general, fragmentation it lowers GDP growth and it increases inflation relative to a world in which you have much more globalization. So this is a major concern of ours. So let me, in the final section, talk a little bit about what this all means for Bulgaria and what we see as the priorities here. I think given what is at stake, trying to reverse this downshift in global growth is really a priority for every country. It can't be the case that one is just hoping for better reforms in Europe more broadly, or better reforms in the US, or a revival of the housing sector in China as the solution, even though for a small economy like Bulgaria, it is going to be hard to grow quickly without faster global growth. So this chart shows the convergence in Bulgaria, and this is the common way that we think about what is the progress on growth in Central and Eastern Europe. It's how quickly the convergence is happening to EU averages. And what you see here is that the convergence has continued in Bulgaria, but slower than in a lot of the other new member states. And I would argue that even this is less of a good metric for progress when Europe itself is not growing very well. So if you looked at this relative to the United States, you would see much less progress, because the United States over the last 20 years, particularly since the global financial crisis, has grown much faster than in Europe. So the question is, how could we do much better in Bulgaria? I think that there are many things that one would want to go right to get growth faster in Bulgaria, but I'll focus on three, again, focusing on these components of GDP growth. The reality is that it's not that hard to identify these issues. It's much harder to implement them. I think the first relates to the labor supply. What you see in Bulgaria is that the first priority is improving labor force participation. Bulgaria has one of the highest percentages of youth that are neither in education nor in work, that are effectively not part of the workforce. I think the first priority is trying to help that group join the workforce more so than they are doing now. As I mentioned earlier, Bulgaria is seeing its workforce fall by 1.5% per year through some combination of demographics and emigration. It is obviously a politically sensitive issue, but it is difficult to solve the demographic issue solely by improving labor force participation. That's part of it, but likely some strategy for immigration is going to be needed as well. The second issue is on capital. If you look at Bulgaria's integration in global value chains, it has basically paused in the last 10 years. So Bulgaria is benefiting less from global trade than it is making less progress on benefiting from global trade. And this is where there's just no alternative to increasing investment in physical and human capital. Infrastructure is okay, but could do significantly better. We think more efficient spending on public education could vastly increase the human capital side of things, which then also affects productivity. We think there's enormous scope to improve digital readiness. There was a report in the paper yesterday on how JP Morgan now has as a requirement for all new staff is training in artificial intelligence. The world is changing on this very quickly, and there's scope for that, for much more of that in Bulgaria as well. To make these investments, and I think this is perhaps the most sensitive issue in Bulgaria, to make these investments in physical and human capital, it will require additional resources. And the most straightforward way to do that is by tapping the RRF funds from the EU, which requires meeting certain milestones, and that will make it much easier for Bulgaria to fund these investments. But there's also the question of more public revenue. And I recognize that every time you say this in Bulgaria, you need to duck because so many people disagree with this. But I think the concern that we have is that a lot of the expenditures that countries like Bulgaria have ahead of it are things that are permanent increases in the obligations of the government. Things like pension spending, defense spending, climate spending. And when you have a permanent increase in the obligations of the government, it is very difficult to meet that without additional tax revenue. Bulgaria has one of the lowest tax revenues in Europe. And so if you see these obligations coming down the road and you don't want to address them via additional revenue, the alternative is additional debt. And debt is something that should be used to finance temporary increases in expenditure like the pandemic, not permanent increases in obligations like climate and investments in education. And then the final one is productivity. And there's many things that go into this, but the one that I would focus on here most is the reforms that relate to governance and corruption. The perception here of corruption, the perception of the degree of corruption remains very high. And there's very specific laws that have been drafted, or in some cases passed, but not enforced, that would vastly improve productivity. The way they would improve productivity is by improving the allocation of capital and labor, rather than having it be a function of the way in which laws are averted. This has the added benefit of the fact that with better reforms to governance, you would also, those are the milestones that unlock the EU funds. So just to recap, there's 4 points. One is that the great news is that inflation has come down without a huge cost to growth. We're not done with dealing with inflation, which is the second point, which is that wages eventually need to moderate and come back down towards productivity, but we've made a lot of progress. The real thing that we should be thinking about in all of our elections, I mean, both the elections that are coming in the United States, elections here, we should be thinking about what are the reforms necessary to reverse the very negative outlook on medium-term growth. And this includes finding a way to increase business investment in fixed capital, finding a way to offset and mitigate the impact of aging demographics, and investing in things that raise productivity. That there's just no alternative to that. And in the case of Bulgaria, it requires stronger capital and access to finance, better infrastructure, and less corruption. I'll stop there.